let's talk about one of the most confusing, just absolutely frustrating puzzles in the stock market. It's that moment that leaves so many of us just scratching our heads, wondering if the whole system is just broken. Have you ever seen a company report amazing, incredible news, only to watch its stock price just fall off a cliff? It feels totally backward, but today we're going to decode exactly why that happens.
So picture this. It's late 2025. NVIDIA, the absolute king of the AI revolution, drops its quarterly earnings, and the numbers, they are just breathtaking. A record $57 billion in revenue. They didn't just beat the Wall Street estimates, they completely crushed them. Sales are through the roof, profits are massive. By any measure you can think of, this is a grand slam home run.
Okay, so logically, what comes next? Your intuition, your common sense, everything you've ever learned tells you that the stock price has to soar, right? The company did great, so the stock goes up. It's like 1 + 1 = 2. It's simple. So what do you think happened?
Yeah, the stock fell. It dropped about 3% right after they announced this incredible news. And listen, this isn't some weird 1 in a million thing. This kind of stuff happens all the time. And this right here, this is the puzzle we're going to solve today. Why objectively fantastic news can make a stock go down, and how understanding this will literally change the way you see the market forever. So here's our game plan. We'll start with why this whole thing feels like such a contradiction. Then, we'll get into the most important idea of this entire explainer, something I call the expectations treadmill. We'll look at some real-world examples, peek behind the curtain at the market's hidden machinery, and then, at the end, we'll build you a brand new mental model for all of this.
All right, section 1. Let's start by just admitting something. The idea that good news equals a rising stock, well, it feels right. It feels incredibly logical because it's based on how we experience the rest of the world. In the real world, cause and effect are usually pretty straightforward. If your team scores more points, you win the game. If you do a great job at work, you get a promotion. We learn this from a young age. Good inputs lead to good outputs. Our brains are literally wired to see things this way. So, naturally, we try to apply that same logic to the stock market. But here's the catch. The stock market is playing a totally different game with a totally different set of rules.
And this really gets to the heart of it. There are two ways to look at a company's news. There's the accounting view, which is like looking in a rearview mirror. It gives you a perfect picture of what already happened. It's a history book. But the market operates on the valuation view, and that's like a powerful telescope pointed way, way into the future. It doesn't really care about what just happened, except for how it changes the view of what's going to happen. A stock's price isn't a reward for a good quarter, it's a bet on all of the company's future profits. The second the news comes out, the market's eyes snap immediately to the future.
And this leads us straight into this little mental trap we all fall into, called the representativeness heuristic. Now that's just a fancy term for a really simple idea. We tend to mix up the idea of a good company with a good stock. You see a company like NVIDIA, they make amazing products, they're dominating their field, and your brain just goes, that's a winner, buy the stock. But we forget to ask the most important question, what's the price? A truly fantastic company can be a terrible investment if the stock price already assumes that they're going to be perfect forever.
Okay, so if the market isn't reacting to the news itself, what is it reacting to? This brings us to the single biggest concept you need to grasp to understand the market. The future is already here.
The phrase you need to tattoo on your brain is priced in. It means that today's stock price isn't a blank slate just waiting for news to happen. No. It's an incredibly complex, living number that already reflects everything everyone knows, and more importantly, it reflects the probability of all the different things that could happen in the future. The market is kind of like a time machine that's constantly pulling the future into today's price.
Let's make this super simple. Imagine a pharma stock is trading at $100. Let's say if their new drug gets approved, the stock is worth $150. If it gets rejected, it's worth $50. So at $100, the market is basically saying there's a 50-50 shot of either outcome. Now the news breaks, the drug is approved. That's awesome news. But remember, the stock was already at $100, reflecting that 50% chance. So maybe it just drifts up towards $150. But what if the approval comes with a catch? Maybe a warning label that will limit sales. The news is still good, it was approved. But it wasn't the perfect news everyone was hoping for, so the stock could actually fall.
See, here's the thing. Expectations isn't just one number, it's a whole hierarchy. At the bottom, you've got the official Wall Street analyst numbers. This is what you see in the headlines, but for the big players, that's just the starting line. The real hurdle is what they call the whisper number. That's the unofficial, much higher number that the big hedge funds are actually betting on. And for a really popular, high-flying stock, there's a third level. It's priced for perfection.
This means the market isn't just expecting a beat, it's expecting a mind-blowing beat plus a promise to do even better next quarter. Anything less than that, any tiny flaw gets punished.
All right, so enough with the theory. Let's look at how this actually plays out with some real companies and some real earnings reports that sent shockwaves through the market.
And this brings us right back to where we started, with NVIDIA, a classic beat and drop. The reality was, they reported fantastic numbers, easily beating the official estimates. But the expectation? The stock was already priced for utter perfection. The whisper numbers were looking for an even bigger beat. And crucially, the guidance they gave for the next quarter, while it was strong, it wasn't the moonshot that was already baked into the price. The good news just wasn't good enough to clear that impossibly high bar.
Now let's look at the opposite, which is even more wild, the miss and pop. So get this, C Limited misses its profit target by a whopping 42%. I mean, that sounds like a complete disaster. But the stock jumped up after the news. Why on earth would that happen? Because expectations were already in the gutter. The market was terrified of a total catastrophe. A giant loss was already priced in. So when the company reported a loss that was just bad instead of apocalyptically horrible, the entire market just breathed a huge sigh of relief. It was a clear case of better than feared, and that's all that mattered.
Now you might be wondering, how does the market figure all this out so fast? I mean, these price moves happen in an instant. Well, it's because there's this hidden machinery at work, operating at speeds we can barely even comprehend.
One of these mechanisms is called IV crush. Before a company reports earnings, there's a ton of uncertainty, right? No one knows what the numbers will be. This uncertainty is like a risk premium that gets baked into the price of options contracts. The moment the news drops, good or bad, it doesn't matter, all that uncertainty just vanishes. Poof, it's gone. The volatility value gets crushed. So even if the stock goes up a tiny bit on the good news, the options tied to it can lose a massive amount of value, creating a wave of selling that can actually push the stock down.
And this timeline just shows you how fast it all is. When that report comes out, high-frequency trading algorithms aren't reading the headlines. They're scanning the raw text for keywords and making trades in 50 milliseconds. That's literally faster than you can blink. By the time you read that positive headline on your phone 10 minutes later, the price has already moved based on the real story buried deep in the report.
So, with all that in mind, how do we shift our thinking? How do we build a new mental model to see the market not as it seems on the surface, but as it actually works underneath?
Here's the most powerful way to think about it. Stop thinking of the stock market as a scorecard that gives out grades for past performance. Instead, think of it like a giant betting system at a horse race. The goal isn't just to pick the best horse, it's to find the horse where the odds are wrong.
Think about it. At a horse race, everyone knows who the favorite is. It has the best record, the fastest times. But because everyone expects it to win, the payout, the odds are terrible. If you bet on it and it wins, you barely make any money. That's NVIDIA in our story. A fantastic company, the favorite horse, but that expectation is already priced in. The real opportunity is finding a long shot, like C Limited. The market expected it to fail miserably, so when it just did okay, the payout, compared to those rock-bottom expectations, was huge. The game isn't about picking winners. It's about figuring out how the results will be different from what everyone already expects.
The legendary investor Howard Marks just nails this with his idea of second-level thinking. First-level thinking is simple. It says, hey, it's a good company, let's buy the stock. That's the trap we've been talking about. But second-level thinking goes deeper. It says, okay, it's a good company, but everyone knows it's a good company, so the stock is priced for perfection. This news, while good, wasn't perfect. Therefore, the stock is actually overpriced now. Let's sell.
So, I want to leave you with this one final question. This is the mental shift that unlocks everything. The next time you see a headline flash across your screen about a company reporting record profits, just stop for a second. The first-level question to ask is this good news? But the real question, the second-level question, is this news better than the absolute perfection that everyone was already expecting?